Most people never think about what money actually is. They see dollars in their bank account, numbers on a screen, cards they swipe at stores. But money isn't the paper or the plastic, or even the numbers themselves. Money is a social agreement, a collective hallucination that only works because everyone believes in it. For thousands of years, that agreement was tied to something physical. Gold coins you could weigh, silver you could melt, paper notes you could exchange for metal at a bank. Then in 1971, President Richard Nixon severed the last connection between money and physical reality when he took the dollar off the gold standard. From that moment forward, money became pure belief, backed by nothing except trust in governments and central banks. And now, in the 2020s, we're about to make that abstraction complete. Central Bank Digital Currencies represent the final transformation of money from physical object to programmable code. And when money becomes code, it can be controlled in ways that previous generations couldn't have imagined or resisted. The story of money is a story of increasing abstraction. In ancient Mesopotamia, grain and livestock were used as money because they had inherent value. People needed food, so food became the medium of exchange. But grain spoils and cattle die, so societies invented coins, metal discs that represented value but couldn't rot or run away. The Chinese experimented with paper money during the Tang Dynasty, but it wasn't until European banks in the Renaissance that paper currency truly took hold, backed by promises that you could exchange the note for gold or silver stored in vaults. The abstraction deepened in the 20th century when checking accounts replaced physical cash for most transactions. Your paycheck was deposited electronically. Your rent was paid with a check. Money became numbers in ledgers maintained by banks, and most people never touched actual currency except for small purchases. The 1971 Nixon decision completed the philosophical transformation. Money was no longer a claim on something real. It was a claim on the collective belief in government stability. And now we arrive at CBDCs, where money is not just digital in practice, but digital in design, existing only as entries in a distributed database controlled entirely by central banks. Understanding how CBDCs work requires understanding how money moves today. When you pay for something with a credit card, you're not actually transferring money. Your bank sends a message to the merchant's bank saying you authorize the payment. The merchant's bank credits the merchant's account. Your bank debits yours. Settlement happens later through a complex series of intermediary institutions, each taking a cut and adding delay. If you send money internationally, it might pass through 5 or 6 banks, currency exchanges, and clearinghouses, taking days and costing significant fees. The entire system is built on trust between banks and layers of verification to prevent fraud. It works mostly, but it's slow, expensive, and opaque. A CBDC eliminates all the intermediaries. Instead of your bank holding your money and sending messages to other banks, your digital wallet holds a direct claim on the central bank itself. Every dollar, euro, or yuan in your CBDC wallet is a liability of the central bank, just like physical cash. But unlike cash, CBDCs live on a distributed ledger, a database synchronized across thousands of computers, making transactions instant, nearly free, and completely traceable. When you pay someone, the ledger updates in seconds. No intermediaries required. The central bank sees every transaction in real time, and because it's all code, the bank can program rules directly into the money itself. That programmability is what makes CBDCs revolutionary and dangerous. With physical cash, once you have it, it's yours to spend however you want. The government can't see who you gave it to or what you bought with it. Banks can track your account activity, but they can't stop you from withdrawing cash and using it anonymously. A CBDC changes that entirely. Every unit of digital currency can carry metadata, instructions embedded in the code that govern how it can be used. This isn't theoretical. Patents filed by central banks around the world describe exactly these capabilities. The People's Bank of China has filed patents for digital yuan that include the ability to track spending, expire currency after a set date, restrict usage to specific merchants or geographic regions, and even remotely deactivate money in individual wallets. The European Central Bank's digital euro proposals include similar features, justified as tools for fighting money laundering and tax evasion. The Federal Reserve has been more cautious in public statements, but the technology they're exploring has the same capabilities. Once money is programmable, it becomes a tool for policy implementation in ways previous governments could only dream about. Consider how this works in practice. Imagine the government wants to stimulate consumer spending during a recession. Today they might send stimulus checks or cut interest rates, hoping people spend rather than save. With CBDCs, they could issue digital currency that expires in 30 days. If you don't spend it, it vanishes. You can't save it. You can't invest it. You must spend it or lose it, guaranteeing that stimulus money enters the economy exactly as policymakers intend. Or imagine implementing negative interest rates. a policy central banks have struggled to execute because people can just withdraw physical cash and stuff it under mattresses. With CBDCs, cash doesn't exist. Your digital currency automatically loses value over time, a program decay that forces you to spend or invest rather than hoard. These aren't dystopian fantasies. These are explicit policy tools that central bankers have discussed in academic papers and conferences. The Bank for International Settlements published research in 2021 outlining how CBDCs could enable innovative monetary policy tools including expiring currency, negative rates, and targeted distributions that bypass commercial banks entirely. The infrastructure being built now includes these capabilities by design. The timeline for deployment is remarkably fast. China launched pilot programs for its digital yuan in 2020 and has already processed nearly $1 trillion in transactions across major cities. India introduced the e-rupee in late 2022 and is rapidly expanding usage. Sweden, facing a population that barely uses cash anymore, is testing the e-krona with plans for full rollout by 2026. The European Central Bank announced its digital euro project with implementation targeted for 2028. Even the Federal Reserve, typically slow to adopt new technologies, has commissioned research and is exploring wholesale CBDC applications for interbank settlements. The infrastructure isn't coming, it's here. In the Bahamas, the sand dollar is already the official legal tender, fully replacing physical cash in digital form. Nigeria launched the e-naira in 2021. Over 130 countries representing 98% of global GDP are either researching, piloting, or deploying CBDCs right now. The rails are being laid, the systems tested, and the policies written while most people remain focused on debates about inflation, interest rates, and whether Bitcoin is the future. The real transformation is happening in central banks and finance ministries, not on cryptocurrency exchanges. The infrastructure required for this system is massive, but increasingly standardized. Central banks are collaborating through organizations like the Bank for International Settlements to ensure interoperability between national CBDCs. The Bridge Project, involving China, Thailand, the UAE, and Hong Kong, is building a platform for cross-border CBDC transactions that bypass the dollar-based SWIFT system entirely. This isn't just about making payments faster or cheaper. It's about creating an alternative financial architecture that reduces American power over global transactions. For 70 years, the dollar's dominance meant that international trade, even between countries that don't use dollars domestically, was settled in dollars through American banks subject to American sanctions and surveillance. A multi-CBDC system breaks that monopoly, allowing countries to trade directly in their own digital currencies on infrastructure they control collectively. The geopolitical implications are staggering. The financial wars of the 21st century won't be fought with tariffs and sanctions, but with competing digital currency blocks, each with its own rules, surveillance capabilities, and alliances. And once that infrastructure is built, reversing it becomes nearly impossible. But the deepest implications aren't geopolitical, they're personal. When money becomes programmable, freedom becomes conditional. You don't just lose privacy over your spending, though you certainly lose that. Every purchase, every transfer, every transaction becomes permanently recorded and instantly visible to the central bank and by extension the government. But more fundamentally, you lose sovereignty over the money you earn. If your digital currency can be programmed to expire, to lose value, to only work in certain places or for certain purchases, then you don't really own your money. You're granted temporary permissions to use it under conditions someone else controls. And those conditions can change with a software update. No legislation required, no debate necessary, just a change in the code. This is what people miss when they hear about CBDCs and think it sounds convenient. The convenience is real. Instant payments, low fees, seamless cross-border transactions. But the cost is giving up the last shred of financial autonomy that cash provided. And once that autonomy is gone, getting it back will require more than voting or protesting. It will require reversing infrastructure that governments, banks, and technology companies have spent billions of dollars building and that they insist is necessary for efficiency, security, and fighting crime. History shows us that once financial control is centralized, it's almost never voluntarily relinquished. The gold standard was suspended during World War I as a temporary measure. It never fully returned. The Federal Reserve was created in 1913 as a lender of last resort to prevent bank panics. Within decades, it controlled monetary policy for the entire nation. CBDCs are being sold as upgrades to the payment system, as ways to bank the unbanked and modernize creaky financial infrastructure. But the powers embedded in programmable money go far beyond efficiency. They represent the ability to enforce economic policy automatically and individually, bypassing democratic processes and legal challenges. And when you combine programmable money with AI-driven central banking, as we explored in the first video, you get a system that can make and execute policy at the speed of algorithms, optimizing for goals that humans set but machines pursue with logical purity that ignores human concerns like freedom, dignity, or consent. That combination, AI intelligence plus programmable infrastructure, is what's actually being built right now, and it's being built in pieces, country by country, system by system, so that no single moment feels like a revolution. But the total transformation is revolutionary, and most people won't notice until the infrastructure is complete and irreversible. That's where we are with CBDCs in 2025. The technology exists. The infrastructure is being deployed. Over 130 countries are actively developing these systems. The geopolitical race is accelerating, and the powers embedded in programmable money are vast, largely invisible, and designed to become permanent. So what happens next? What does the world look like in 2035 when these systems are fully operational, when AI and CBDCs are managing the global economy? That's not speculation, that's projection, based on what's being built right now. And the scenarios range from optimized prosperity to catastrophic failure, with the most likely outcome being something that looks like freedom on the surface but operates like control underneath. That's what we explore next, because understanding what's being built is one thing, understanding what it means for your life is another. Subscribe if you want to see how this ends. Part 3 walks through the future scenarios. This is Obsynia, where tomorrow's consequences meet today's decisions.